So we just talked about that big spike when it comes to oil prices. I just want to get your reaction as a U.S. producer. When you heard about those surprise OPEC cuts, what did you think? What did it mean for your business?
Well, we've had a pretty volatile time here in the last few weeks, seeing oil prices in the low 60s and now jumping up into the 80s. So I think we are pretty refreshing to see it at $80 oil, given where service costs are. In the low 60s, there was a misalignment between service costs and commodity prices, and where we are today feels a lot better in terms of that alignment between costs and our ability to go out and execute our programs at reasonable economic rates. So I'm pleased to see oil in the 80s.
All right, I want to spell this out for the audience. When you say service costs, you're talking about the cost to produce, transport, store, all those kind of things?
The cost to drill and complete wells and bring new wells into production to actually increase our production volumes from where they stand today going forward.
All right, obviously a very CapEx intensive business. So when it comes to oil prices, is there a bit of a sweet spot? Is there a range where it's profitable for you and it's also worthwhile to put some CapEx money into drilling more?
Absolutely. We're at that range right now at $80 oil. We feel pretty good about what the economics look like in our drilling programs. When you get into the lower 60s, and you have commodity prices there, and you have service costs that are much higher than what that can support, then our economics are lower and we're not going to produce as much oil. We're going to cut back on activity. You're seeing some of that right now related to the gas areas, with gas being so low and service costs being much higher than what they can support.
All right, we talked a little bit about the macro impact of OPEC and their production cuts. I also want to talk about something closer to home. When the United States decided not to refill the SPR, the Strategic Petroleum Reserve, what did that mean for your business, and what does it mean long term?
Well, when oil prices are high, it's probably not the right time to fill up the reserve. And so maybe we got to sit back and wait till oil prices subside some, and then you may not have that demand or the supply, the ability to be able to fill up the SPR, because everybody's trying to sell their product as much as they can, or they're going to slow down if oil prices are lower. So it's a balance that the government has to take into account when oil prices are this volatile. And I'm afraid that it's going to continue being a challenge for the government to figure out the right time to fill up the SPR.
All right, using the word volatile. So what does that volatility mean for your business? This is obviously, again, a very CapEx intensive business. When you see all this volatility, what does it take for you to feel confident to make the investments to ramp up production? I think a lot of people, who just watch say, hey, oil prices are up. Why don't you ramp up?
Yeah, it's not that easy. First of all, we have a service industry that we need to make sure can keep up with the activity level. And when oil prices are higher and we're pretty much full on the service side and we can't find new laborers to help in our fields execute on those plans, it makes it difficult. So for us, I think where we are right now is probably at pretty close to max capacity in the Permian Basin with activity levels. If we were trying to increase that activity level, we would need the ability to get permits quicker in where we have federal acreage. We need the ability to get pipelines into the ground quicker to get so we could get those wells online sooner. And we'd also probably need a view that oil prices aren't going to be cut anytime soon to a bigger degree than in the $70 to $80 range, that we're confident that they'll stay in that range. But it's a very manpower, capital intensive business, like you said, and we need the service companies. And so to ramp up production, we're like I said, we're pretty much at full capacity today with the activity level we've got.
All right, so you hit on my last question, prices. Right now we're seeing WTI at about $80.60 a barrel. Where do you see it going from here? You obviously have a lot of visibility, not only into demand, but also production.
Yeah, the demand, not only in the United States, but around the world, is going to probably somewhat dictate where oil prices go. The Saudis obviously feel that at this level, it's a floor that they're requiring for their own needs. We feel pretty good about the future at $80 oil. So I'm not going to forecast where oil prices are going. I'm going to try and run my business to create profitable growth in almost any environment, but surely $70, $80, $90 oil in that band, we are very confident about our ability to profitably grow our business.
Yeah, again, right now, WTI at about $80 a barrel. So I want to hit on something else you mentioned. So you mentioned you're pretty much at max capacity, and to ramp up, it would take investment and some other time. But some of your peers, they may not be at max capacity. So right now, as an oil producer, do you look at your oil production as a factor in inflation? Is that something that you think about? Is that something you and your peers think about?
Not really. I think one of the demands that we have on us is that investors are requiring us to return capital or to shareholders in some form, and as that is imposed on us as producers, then we're going to have to live within cash flow or provide some free cash flow back to the shareholders. So that drives some of our thinking as well in terms of our being at max capacity, that we're not going to increase activity levels just because oil went to $80.